Great to see you, Frank, and everyone else.
So, Tom, you have certainly been the bull on halftime. You've been the one tooting the horn that we're set up for a rally. Based on all the information that we have right now, do you still believe in that rally? I know, a silly question. I know you do, but do you still believe in that rally? And what data can you point to people who are skeptics that they should kind of look at to also jump on the train that you're on?
Well, foremost, I know there was some talk about inflation. I think there's more good news in the pipeline on inflation. Just gasoline alone will probably subtract almost 80 basis points from CPI month over month in August. So it's a bigger improvement. But the story there is things like leading indicators, alternative data, commodity prices, even surveys show that underlying inflation and leading indicators are far lower than hard data like CPI. So I think July was a break in trend that's caught a lot of people flat-footed. And then if that's true, it does set us up a lot like August 82, which is the stock market bottomed in August 82, almost 10 weeks before Paul Volcker abandoned the anti-inflation fight. And that entire stock market rally of 4 months erased a 3-year bear market. I just think the key here is if investors are bearish on all sides and skeptical and think that the hard data is driving this, 82 tells us that we could have a very steep stock market move. Similar to what Joe was talking about, that 43.50 might be a magnet, but I think the all-time highs of this year will be realized before year end.
Tom, by the way, your CNBC Pro Talk on CNBCPro.com, the highest rated ever, where you kind of break down your thesis for the second half rally. So speaking of it, you actually believe the rally is strengthening with a focus on lower quality. Exactly what do you mean by that?
Well, it's something we highlighted to our clients today that Mark Newton, our head of technical strategy, says one of the nice things developing this week is there's been a breadth expansion. More stocks are participating and adding to, advancing. When you have a breadth expansion, investors are going to shift away from quality and sort of the big cap leaders and move towards lower quality. So we were highlighting some lower margin names, companies with higher debt to capital, more highly shorted, but also technically attractive, and we had 6 stocks. And by the way, Frank, great to hear about the CNBC Pro.
You were excellent. Joe, I believe you have a question for Tom.
I do, Tom. So I've been expecting a U-shaped recovery. I thought this would be different than a lot of the corrections we've witnessed since the great financial crisis. It sounds like you think this is going to be a V-shaped recovery. Yeah. Speak a little bit about position and sentiment, and do you think that the market is prepared for that type of fast V-shaped recovery?
Joe, it's a great question. I think the thing that's keeping a lot of fundamental investors sidelines is they think companies have to cut earnings. And therefore, they're fighting this and really saying only technicals are driving the rally. But one thing we have to keep in mind is that post-pandemic, companies survived a depression with good margin expansion. Now they've survived 6 months of almost hyperinflation and negative GDP with double-digit earnings growth. These are fundamentally better businesses, and I think their multiple is re-rating. So it's very similar to 82. But again, I think that's what's going to drag investors in, because if we emerge from this, as we point out, CPI weakening, and then China starts to improve, and of course, it's kind of positive that Xi is leaving the country, we could see a fundamental tailwind develop along with cash flowing in. That would be a huge technical driver for all-time highs, and I think it could come very quickly.